One former high-ranking Fed official is urging the central bank to set up a bailout facility for hedge funds. Will it happen? What does this mean? Isn't this a stealth QE? Before we get into all of those, we're not talking about every hedge fund. We're only talking about a specific group of 10 or so that are heavily involved in the Treasury market. And they were also heavily involved in the March 2020 crisis when interest rates skyrocketed, and everybody's been saying ever since then, broke the Treasury market itself. At least that's what officials and former officials want you to think. While hedge fund selling was indeed a big part of the disruption of the Treasury market, the real story goes far deeper than that. Bailing out these funds in the future doesn't fix the real problem, which is another legacy of how the 2008 crisis, it's still with us right here in 2025. And this story involves futures markets, repo, collateral, zero haircuts, and a whole bunch more. But you really don't need to know anything about those to understand what's going on here. In the end, this is pretty simple stuff, though it's one thing that authorities in particular really don't want to talk about it. They'd rather just construct a bailout mechanism and wash their hands of the whole thing. Except a bailout wouldn't really work, and it's really only intended to get people to stop thinking about this. It would be, in essence, another PR campaign, which is what the Federal Reserve really does. And you got to tip your cap. They do it really well. And so a bailout of the Treasury market, which you hear this all the time, or at least frequently for those who are paying attention, they keep hearing about the Treasury market liquidity, it's broken, there's potentially this problem with hedge funds. What happened more recently is that a paper was published which is urging the Fed to set up a bailout facility for these funds. As Bloomberg reported, what they urged was a better way of stepping in via hedge bond purchases, at least according to Brookings Institution paper by a bunch of authors, which include Harvard University's Jeremy Stein. If hedge funds need to unwind their positions quickly, the danger is that bond dealers may not be able to handle the enormous sudden volume of transactions, which is what we saw in March of 2020. When the Fed had to intervene in 2020, the basis trade, which is what we're talking about here, was roughly $500 billion in total, which is just half of today's figure, which gets to be upwards of $1 trillion. To relieve stress on dealers, it would be sufficient for the Fed to take the other side of this unwind, purchasing Treasury securities and fully hedging this purchase with an offsetting sale of futures. One of the reasons I mentioned Jeremy Stein is because as a former Federal Reserve Board governor, if he's talking about it and taking it this seriously, chances are that they're talking about it and taking it seriously at the Federal Reserve itself. And this topic of hedge funds and the basis trade has come up repeatedly ever since 2020. Every once in a while, you'll see a study or a paper or a comment by some official that says, we're worried about Treasury market liquidity. Is the Treasury market broken? And one reason why is because of what happened in 2020 and the misunderstanding about what really went on. So you've got the idea of a broken Treasury market. You've got a former high-ranking Fed official, Jeremy Stein, even though he hasn't been at the Fed since 2014. Again, as he's talking about it and taking it seriously, and this paper was published by Brookings, another establishment type of outfit, think tank, it's very likely that the Federal Reserve is considering the same thing. So what are we talking about? Bailing out hedge funds for? What is this basis trade? The basis trade is it's futures markets, cash markets, repo, and collateral, but essentially it's pretty simple. There is a situation in the futures market, Treasury futures, where the futures price is more expensive relative to cash treasuries. So what happens is there's an arbitrage opportunity there. Because the futures price is more expensive relative to cash treasuries, you short the futures contract, which is why there's so many short Treasury contracts to begin with, and go long the U.S. Treasury funded in repo. Because these returns aren't huge, that's why it's called basis. It's just a few basis points here, or fractions of basis points in some ways. Leverage is absolutely critical, which is why repo comes into it. So if you're shorting the Treasury future and going long U.S. Treasuries, if you fund that in repo, which means you can fund almost the entire purchase, or for those hedge funds that are well connected, like the group that we're talking about here, you're probably getting zero haircut, which means you don't have to put up any of your equity or a very slim amount of your own equity, which means you're getting tons of leverage. So even just a couple basis points means huge returns. And because shorting futures and going long treasuries in the futures market, that means that the futures price and the Treasury price are going to converge over time. There's really no risk to this transaction. Essentially, you have this huge opportunity from the futures market tied in with repo, which all means massive amounts of leverage returned, which these hedge funds are uniquely set up to take advantage of. The problem, or multiple problems with this basis trade setup, is what happens when there's an issue in repo. Because repo, as we learned, or many of us paying attention learned in 2008, means you have rollover risk. So you're funding your positions in the short-term repo markets, which means you have to roll over either every day or quite frequently, because even term repo is not termed out for several years. It's termed out for a couple months at most. So you've got to constantly roll over your funding, which means if the funding doesn't roll over, your leveraged position needs to be sold, which brings us to March of 2020. And if you remember, during the meltdown, the crisis, the worst part of the crisis, contrary to expectations, you would think flight to safety, bond yields are going to go down as everybody pours into treasuries. But we saw the opposite happen. Bond yields, especially longer-term treasuries from illiquid off-the-run securities, started to rise and rise pretty precipitously. And the reason was a combination of factors, but it included this basis trade going bad. You had a breakdown in the repo market, which meant that funding wasn't being rolled over, which meant liquidations of U.S. Treasuries on top of everything else that's going wrong. So if you look at interest rates rising, you look at lack of liquidity in the Treasury market, which was reported in widespread fashion, you're thinking we need to do something in case something like this happens again. We need to have a bailout facility from hedge funds that engage in the basis trade, because if we don't, we're at risk of seeing another March 2020. There was one paper that was published in April 2021 that really set the stage for this idea that we need to do something about the basis trade. The Treasury market is broken. It's called Hedge Funds and the Treasury Cash Futures Disconnect, which was written by Daniel Barth of the Board of Governors, the Federal Reserve, and R.J. Kahn of Treasury's OFR, or Office of Financial Research. And in that paper it said, during March of 2020, all three of these risks materialized. Real money investors sold treasuries, margins on futures contracts increased, which is essentially a collateral call, and repo market illiquidity drove repo rates up and made it more difficult to continue to create the leverage that is needed for the basis trade to be maintained. The model therefore illustrates how the imperfect nature of hedge fund warehousing can create or amplify stress in the treasury markets. And of those three things, here's the whole thing in a nutshell that nobody focuses on because you're not allowed to. Large sales from foreign central banks and asset managers put pressure on dealer balance sheets, raising treasury price volatility, margins on treasury futures, and increasing uncertainty on repo rates with treasury collateral. In response, hedge funds appeared to have reduced their basis positions, selling cash treasuries and purchasing offsetting long futures contracts. Because if your arbitrage is to short treasury futures and go long treasuries in cash, and you can't fund the long part anymore, you've got to close out your position in the futures market. It leads to chaos and volatility. But the focus on basis trade selling is looking at the end of the line, of the last part of that process, and it's basically applying a Band-Aid to a gaping wound. The wound is at the front. What started this to begin with? And the passage that I just quoted tells you everything that you need to know about where this actually came from. It's not about hedge funds and the basis trade. It's not even about treasury market liquidity. It's the first part they said, large sales from foreign central banks. What really happened in March 2020 is not what anybody has ever said about March 2020, because they don't want to talk about March 2020 in the same way they don't want to talk about 2008, except to blame it as subprime mortgages. What really happened in March 2020 was, confronted with all of the negative prospects associated with lockdowns, the pandemic, uncertainty, tremendous amount of uncertainty, the dollar system seized up. And it did so because, even despite the fact the Fed had new tools in its toolkit, the dollar swap, overseas dollar swaps, those programs were open, and yet you had a global dollar shortage, a massive global dollar shortage. And everyone here at Eurodollar University knows what happens in response to a dollar shortage. Reserve managers outside the U.S., when faced with their local banks having troubles securing funding in the dollar system, will sell the reserve assets to help make up for that shortfall in market-based funding. Selling reserve assets mean selling treasuries. But they don't just have U.S. treasuries lying around. They don't just have liquid U.S. treasuries lying around. That's another myth that needs to be dealt with. The Treasury market isn't entirely liquid. Even though we talk about the Treasury market being the deepest, most liquid market in the world, that doesn't mean that every single Treasury out there, all 36 trillion of them, trade on a regular basis. There is definitely a liquidity hierarchy when it comes to Treasury markets, the Treasury market securities as well. On the run securities, those that are just auctioned off, they tend to be highly liquid because they're the securities that most accurately represent the current conditions. Whereas off the run securities, stuff that has been sitting around somewhere in a reserve manager portfolio, for example, for years, that one's harder to sell. They're not as liquid as an on the run security. But if you're a reserve manager that has a lot of off-the-run securities, suddenly you get a dollar shortage in your local jurisdiction, you need to do something about it, you need to sell your U.S. Treasuries, what do? Well, since there isn't a deep marketplace, you contact the local dealer, U.S. dealer most of all, you contact a Eurodollar dealer and say, I got to sell my Treasuries to raise cash so I can deal with this dollar shortage that I have in my area. And so the dealer will buy the U.S. Treasury, whether it's liquid or not, because they want to accommodate some of their biggest customers. That's what reserve managers are. So if a reserve manager says, I'm going to sell you this Treasury, you say, yeah, I'll take it. But dealers most often, they fund these transactions. They don't want the Treasury because that's not what dealers want. They want to bring in securities and get them out the door. So they'll temporarily warehouse the security by funding the purchase in repo. So they're also in repo. So you have a major dollar shortage that leads to these foreign reserve managers selling tons of illiquid U.S. Treasuries that end up on the books of dealer banks, and dealer banks have to fund these securities in repo. At the same time, the repo market's breaking down because it's a dollar shortage to begin with, which means that the repo market gets even more problematic. And so it's a problem for dealers, and they have to sell U.S. Treasuries because if they can't fund it in repo on the terms that they need, they're going to have to liquidate in the marketplace as well. And then the basis traders who are having the same issue, who are funding their positions in repo becomes more problematic for them, they add to the selling, and it leads to a cascade of trying to unload illiquid U.S. Treasury securities on a market that simply isn't able to absorb all of that selling. The problem isn't the selling. The problem is the dollar shortage that precipitated it. But we're only supposed to look at the selling as if that's the issue that we need to fix, rather than going back to the dollar shortage the Fed has proven time and again it cannot fix. The dollar system is broken. That's the problem, but we can't talk about that. So let's talk about bailing out hedge funds. And it's not as if the Federal Reserve or the FOMC isn't aware of all this. In fact, the minutes for their March 15, 2020 meeting contained a passage that referred to exactly what I'm talking about here. It said, in the Treasury market, following several consecutive days of deteriorating conditions, market participants reported an acute decline in market liquidity because of what I just said, all the selling that was precipitated by the dollar shortage. A number of primary dealers found it especially difficult to make markets in off-the-run Treasury securities and reported that this segment of the market had ceased to function effectively. There's too many sales. The problem isn't the sales, it's the dollar shortage that make people sell. This disruption in intermediation was attributed in part to sales of off-the-run Treasury securities and flight to quality flows into the most liquid on-the-run Treasury securities, which was itself a collateral call, because in the repo market, all you care about is liquid collateral. And if off-the-run Treasuries become more and more illiquid because of all the selling, everyone gets herded more and more into the part of the Treasury market that is liquid, which is on the run. So basically here you have the FOMC at its meeting during the meltdown. They're spelling out what was wrong in March of 2020 without connecting to the dollar shortage part, which they actually do describe in the very next passage. It says, conditions in short-term funding markets also deteriorated sharply amid a decline in market liquidity, there's your dollar shortage, and challenges in dealer intermediation. Over recent days, the premium paid to obtain dollars through the foreign exchange swap market increased sharply, and the volumes in term repurchase agreement markets dropped significantly. So there it is. Even the Fed is talking about global dollar shortage, but not connecting it to the Treasury market illiquidity, even though they know and they said foreign reserve managers were selling their U.S. Treasuries. They're not connecting it in public because they don't want the public to know the Fed is not an effective central bank. That's what this all comes down to. That's what QE's been about. That's what the focus on bank reserves has been about, covering up this major fact, the fundamental truth. The Fed is not really an effective central bank because it's not really a central bank. And so the issue is not hedge funds. The issue is dollar shortage. And we've seen this before. Not just in March of 2020. We actually saw the same thing without the basis trades, without hedge funds at all, in October 2008. We saw reserve managers faced with a massive global dollar shortage sell U.S. treasuries, leading to the same types of behavior. A breakdown in the treasury market, which everybody worried was, oh my God, the treasury market, there's lack of liquidity, it's breaking down. It wasn't breaking down. It was precipitated by a dollar shortage the Federal Reserve is incapable of handling. Just look at how the treasury yields behaved during the worst of the crisis. Remember, this is the worst crisis in generations. You had treasury yields, we'll just focus on the 10-year here, falling all the way to 3.62 by early September, which makes sense. Flight to safety, demand for safety and liquidity. Then they kept falling through Lehman Brothers, the announcement of the GSEs, and then Lehman Brothers the next week, AIG, Merrill Lynch, and all the stuff that happened in the middle of September. By September 17th, the 10-year treasury yield was 3.41%, which makes sense. So down 70 basis points from July, and it looked like they're going to continue to go lower. But for the next week, treasury yields went up, and went up by a lot. By September 25th, only 8 days later, as everything was melting down, the 10-year treasury yield was 388, up 47 basis points in only a little over a week. That didn't seem to make sense. Then you had deteriorating conditions the end of September into early October. The 10-year treasury yields down to 3.48. That makes a lot of sense. From then, over the next several days, the treasury yield backs up by 60 basis points. As everything's going to, stocks are being sold, the entire financial world is melting down. Everybody, you would expect flight to safety. Bond yields are going to go lower, but here's the 10-year treasuries going in the other direction. It's going higher by quite a lot. And it would stay high. It would go back and forth around 4% all the way through the end of October. Why? Dollar shortage forced reserve managers to sell their U.S. treasuries. It's not about hedge funds, not about basis trades. It's dollar shortage stuff. The Fed is not an effective central bank because it's not really a central bank. While all this was taking place, the Federal Reserve's overseas dollar swaps, which have been endlessly hyped ever since they were first issued back in December of 2007, which is another clue that didn't work, there was $62 billion already outstanding in the Fed's dollar swaps. Even before we got to the events of middle September, that shot up to $407 billion by the middle of October as the Treasury market appeared to be melting down, which meant that reserve managers were still feeling they had to sell their treasuries even while these dollar swaps were available and being used in that fashion. The Fed's programs never actually work. And if that wasn't enough, we saw this happen again, not to the same degree, just a couple months ago. Back in late November, December, and through the middle of January, while everybody was talking about the Trump trade and renewed inflation pressures or higher for longer from the Fed, remember the Fed's hawkish rate cut? Treasury yields were backing up, not because of all those factors or any of those factors. Treasury yields were backing up because we had another dollar shortage. We see lots of evidence for this, as I've talked about since then. You had the 10-year U.S. Treasury that was down around 4.15% on December 6th of 2024, just last year. And then it backed up to 4.4% by December 17th. So even before you get to the Fed and its hawkish rate cut, you got a 25 basis point move upward in the Treasury yield. That wasn't inflation expectation. It was reserve managers that were selling. By the end of December, you're talking about 462 on the 10-year Treasury, and it got to a high of just close to 4.8% in the middle of January. And we can even see evidence of this Treasury selling by foreign reserve managers from the Federal Reserve itself, FRBNY's custody data, where the Federal Reserve branch in New York holds U.S. Treasuries that are owned by these foreign reserve managers in custody for them. The balance of those Treasuries that were in custody at FRBNY dropped precipitously in the same way and almost to the same amount that they did in 2020, as well as in March and April of 2023. Dollar shortages, foreign reserve managers sell their U.S. Treasuries. Sometimes that leads to a backup in yields when you would think that yields are going down. This has nothing to do with hedge funds. And the only reason that hedge funds have been engaging in this basis trade, and the basis trade exists to begin with, is simply another legacy of the 2008 crisis. The banking system, in particular money dealers, they are constrained. Their balance sheets are constrained, which means they don't have the capacity to absorb treasury issuance like they used to. And so hedge funds are essentially stepping in and offering a cleaner balance sheet that is able to take on these massive amounts of U.S. Treasuries that have been issued and hold them as long as they're getting this basis trade and arbitraging and leveraging the returns they get from the futures distortion. That futures distortion is also another legacy of 2008 because dealers are constrained. This is a way to essentially tax the futures market, therefore the entire financial system, in order to allow hedge funds to create balance sheet capacity that dealers can't. It's the free market way of trying to work around all of these massive systemic constraints that are still with us since 2008 because the Fed and its QE, they never work. They don't do what they're supposed to do. They didn't print money. Money printing is balance sheet capacity, and just the fact that the basis trade exists shows you that the money printing capacity has been constrained in a very serious and systemic way for the last 17, almost 18 years now. The simple fact of the matter here is this isn't about hedge funds or the basis trade or a bailout facility at all. The bailout facility is simply looking at the end of the line of that process and saying, this isn't good when basis traders have to sell their treasuries, so we should do something about basis traders. Instead, what a real central bank would do would say, that's just the end of the line. We should go back to the beginning and do something about the dollar shortage or the financial volatility, as that paper called it, and stop that before it even gets that far. But we know that they can't do that. The Fed isn't actually a central bank. They have no way of really dealing with a dollar shortage effectively. And so their response is to, well, let's just limit the cleanup after a dollar shortage happens that we can't do anything about and hope that by cleaning everything up, it will limit the damage from getting to be too far. That's what the Fed actually is. It's a janitor. It's not a central bank. They're just hoping to, after the dollar shortage shows up, they can't do anything about, maybe they can limit the fallout from it. That's what the hedge fund bailout facility is meant to be. That's where the focus really needs to be, on the start of the process, where it all begins, where it's all coming from, the monetary system. This is exactly what I talked about in a video a couple days ago about needing to reset the system. We need to reset the system because the dollar shortages are far too frequent and they are potentially destructive. And so what needs to happen is we need to get rid of the Fed, not because it prints too much money, it's going to destroy the dollars, because it isn't what everybody thinks it is. And in fact, even more than that, even deeper than that, money isn't what everybody thinks it is. So we need to go back and understand where all of these things are coming from, truly understand all these things are coming from, rather than try to slap on a Band-Aid that doesn't really answer for anything. What I actually said was in that previous video is that we need a crisis in order to get to this situation where people are talking about the right things. And that's the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.